Okay, if you can hear me, let's continue. So we stopped at audit sampling. Um, a little recap. Last week we mentioned how external auditors can place reliance on the work of the internal auditors, how they can place reliance on the work of other experts, especially when these experts have specialized skills. The reason auditors usually engage experts to to provide additional assurance on items in the financial statement is because there is the likelihood that in most cases we have some very unique items in the financial statement that do not that cannot be you cannot provide assurance on those items because they are not accounting related, because they are not finance related, they are not audit related. For example, we talked about getting to know pension liability, or maybe some quantity of assets under the ground. So we mentioned a lot of things. So that note is quite straightforward. I would not want us to go too deep in it. But areas we said you likely use as auditors expert is in determining physical condition of assets like minerals underground, oil reserves, precious stones. Also, if you want to know the work in progress, you might need a quantity survey, or maybe there's a building, there's a they are building a particular complex, and they need to recognize what part of that building has been completed. They might need a quantity surveyor to give them those um, specific percentage of work in completion. Pension assets, pension liabilities, those are other areas. When we talk of also legal interpretation of contracts, or maybe there's a case in court, you might need a lawyer to tell you the possibility of that case going for or against the client. Because you remember that usually we are supposed to make provisions for any known loss. So things like that. So we won't waste time. But what usually influences the auditor's decision, we already mentioned it. How risky is that part of how risky, what's the risk of misstatement for that item? The sufficiency and appropriateness of the audit evidence, those are one of the things that usually influence the auditor's decision to use an expert. And we also said what you need to consider when you choose an expert. Don't let these things um, don't let these things kind of give you any issues. The same thing you consider when choosing an expert is the same thing you consider when choosing any professional outside: their reputation, their experience, their independence, whether they belong to anybody, are they bankrupt, do they have a practicing license, what is their past experience. However, we also mentioned that before you place reliance on the work of any expert, the auditor needs to also do what we call um, test of appropriateness, or test of that you have to test that assumption, reasonability test. Yes, you have to test the assumption the expert has used, because the sole responsibility of expressing the opinion belongs to the auditor. And I also mentioned last week that in some jurisdiction, you are not allowed to mention if you have used an expert. So, but I'm not sure you are going to be tested on that. But basically, when you use an expert, you may not want to mention that you used an expert for any reason. In some places is allowed, in some places is not allowed. Agreements with that expert, just like engagement letter, all those things you find inside the engagement letter, those are the things you're still going to find in an agreement with the expert. The scope and nature, the objective, the fees, the extent of the client's information, confidentiality, what are the responsibilities of all parties, and the period, timing, whatever. If there's a target performance measure, you can also try to include all that inside your engagement letter. And that is to make sure, or rather reduce the possibility of running into problems or disagreement with the expert. So we talked about internal audit as well. So please read through your notes. If you have any question, you need to direct those questions to me. I've not been receiving any questions from you. I hope all is well. I hope all is well. There are also certain factors that you need to consider before you place reliance. They are all in your notes. So, having said that, we can now go to audit sampling. So, what exactly is audit sampling? In the past, I'd mentioned it in class, but I'm not sure anybody can remember. But when we talk of the issue of audit sampling, it's just when we apply audit procedures on less than 100% of the population. Once you apply audit procedures on less than 100% of the population, then you are applying sampling. In most cases, at times it might be very difficult for you to actually test the whole population, either due to the sheer size or complexity, or probably you might not even have all the resources to carry out the whole audit. For instance, if you are to audit MTN now, I want to doubt that there's any auditor that will carry out 100% audit of MTN. However, you remember that when we discussed CAT using computer-assisted audit techniques, we said those are the new technologies that allows the auditor to actually, even where possible, do 100% work. But for an assignment that is to last you probably 2 weeks or 3 weeks, how do you now carry out a test on 100% of transactions in an organization? So by this, we said audit sampling is a way out, and audit sampling is simply when you apply audit procedures on less than 100%. And when you now apply these audit procedures on less than 100%, what you are trying to do is that you are taking that population, that sample, you are taking it to represent the whole population. So that's to tell you that whenever you are selecting your sample, you need to be very careful. You have to be sure that your sample represents every nature in that population. If you are talking of a class now, if they tell me to select a sample from our class, I can't select all women, knowing fully well that we have men in the class. We have Fola, we have Ayo, we have Peter, we have Abraham. So I will not be able to select only women. So when you are selecting your sample, ensure that your sample is such that all the variables in the population can be fully represented. Now, there are different types of samples. There are different types of sampling techniques, but of course, I said the way you select it, you should make sure that it represents the population. But the most commonly used samples are broken down into two. One is the statistical sampling method, and the second is the non-statistical sampling method. Is somebody trying to draw my attention to something? Okay. Okay. So we have two types of sampling methods. You say one is statistical, the other one is non-statistical sampling method. And I need you to get this very, very clear. When we talk of statistical, it just means that we use some kind of technique, some kind of technology in getting these samples. For statistical sampling, you have random sampling and systematic sampling. For random sampling, it is actually very easy, because in a random sample, what happens is that we don't decide in advance any pattern that we are using in getting this sample. we just go for the sample unit from the population, meaning that in a statistical sampling approach, basically the random, all the items, every item in that population has the same chance of being selected. In random, all of them has the same chance. So it's not possible for you to, in fact, in a random sample, what it means is that when you keep selecting the sample, selecting, it might get to a point where you could have selected all members of the population. But for systematic sampling, this is when you now use fixed interval between selections. But what you do is that first item you select is going to have fixed interval, but the first item you select is going to have what we call a random start. For example, if we are to select from 1 to 100, and I'm supposed to select 5 figures. Now, for random sampling, without any particular method, I can just select 10, 100, 99, 12. Everybody has the same equal chance. But when you are talking of statistical sampling, what it means is that you are first going to randomly select the first sample. Probably you just decide to select 7. And after you select 7, you now put a fixed interval between them. That's from 7 now, you put interval of, say, 10. Now, that means the next sample is going to be 17. After 17, you add 10 again. That means it's going to be 27. After 27, you are going to have 37. After 37, you are going to have 47. So, but just have it in mind that the first number, the first sample selection is selected with a random start. So if 5 is the first one and you want to put a fixed interval of 5, that means you are going to have 5, 10, 15, 20, 25, 30. So that is it about systematic sampling. For non-statistical sampling, here you have both haphazard sampling, block sampling, monetary unit sampling. For haphazard is that time that you do not even need to have any method. You don't use any structure, you don't use any technique. Like now, I'm holding an exercise book. If you ask me to select, say, 5 pages, in haphazard, all I need to do is open the book without any structure. I pick page 90. Without any structure, I pick page 142. Without any structure, I pick page 174. Without any structure, I can pick page 32. So there is no technique, there's no structure, no order, there's no pattern. You just select it whichever way you want to select. So that is for haphazard. Then when you are talking of block sampling, this is where you actually group transactions into, you group them separately. For instance, okay. So for instance, when you are talking of block sampling, if I want to select transactions from, say, I want to select transactions from the whole year, January to December. If I'm going to use block sampling, what it means is that I might now block them into months. Say I'll select from January, I'll select from February, I'll select from March, I'll select from April. That is block. That's, you put them in groups and you select samples from them. For block sampling, I can say these are the women, these are the men. Or let me say those between the age of 20 to 30, this is their group. Those between the age of 31 to 40, this is their group. 41 to 50, this is their group. Then I'll now select individually from all those. So that's block sampling, selecting the items from a block of items. You can even, for block sampling, you can even say, maybe you have a payment voucher. You have a payment voucher or a goods received note. you might say, okay, from goods received notes 1 to 50, I'll select 2 samples. From goods received note number 51 to 100, I'll select from there. From 101 to 150, I'll select from there. So that is actually how you do when it comes to block sampling. Haphazard, we said haphazard does not have any structure. If you want to pick five pages as your sample in this book for haphazard, you just open it. You can even close your eyes and pick the first one. This first one is 136. You can close your eyes, pick the next one. This is 174. Close your eyes, pick the next one. This is 18. So that's haphazard. No style, no structure, no technique. Block sampling, you group all the samples into different blocks and you select from there. January, February, March, April, May. You select from January, you select from February, you select from March, you select from April. Or you select from PV number 1 to 50, you select inside. From 51 to 100, you select. Or you say age, from ages 21 to 30, you select. From ages 31 to 40, you select. From ages 41 to 50, you select. So that is it with block sampling. Please don't hesitate to stop me should you have any issues. So for monetary unit sampling, this is just where we select all items based on their monetary value. All items based on their monetary value. This is very commonly used. I use this a lot. For example, if I'm supposed to audit certain transactions and there are so much, I might decide to say, okay, all transactions from 1 million naira and above, I'm going to select all of them. Then you now start talking of selecting few from those below. So monetary sampling is when you select items based on their monetary value. So this is basically it. But you know, selection of samples is also affected by the level of sample risk. Now, what is sampling risk? What is sampling risk? Please note it down, write it down. Sampling risk. What is sampling risk? Sampling risk, just as simple as saying that the auditor's conclusion may have been different had it tested the whole population. You know, the reason why you are selecting samples in the first place is because you cannot perform 100% of the job. So if you cannot perform 100% of the job and you have selected a sample, and this sample is supposed to represent the whole population. So if this sample is supposed to represent the whole population and you have now selected a sample that you have worked on, so there's going to be a sampling risk where you are going to be having a separate or a different conclusion if you did the whole population. What it means is that there's an error in your sample selection. The way you selected your sample, it has not kind of what we say represented the whole population. So for characteristics of having a very good sample is that situation where should you have even tested the whole population, you come to the same conclusion. So, but if you now test 30% of the population and you think you've done a good job, and at the end of the day, something happens, you need to test 100% of the population, and you are now getting a different result, that means your sample was faulty. So, so sample risk is the risk that the auditor's conclusion may be different from the conclusion that would have been reached had they subjected all the whole population to audit procedures. That is sampling risk. Please, this sampling risk and types of sampling is very common in your exam. It will be tested, but I'm just hoping that very, very soon we can finish this syllabus and all we need to do will be coming together to solve questions. Please forget about COVID-19. Your life has to continue. If you have the plan of writing or becoming an ACCA member, it's important that you use the opportunity which this COVID-19 has given you to stay at home, study, and practice enough. So these are the two types of sampling risk. One is the risk of incorrect acceptance, and the second is the risk of incorrect rejection. You know, so when you sample certain items, and you use that item to come to a conclusion about the whole population. Now, what we are saying now is that based on your sample, there's a risk that material misstatement is assessed as unlikely, when in fact the population, the entire population, is actually materially misstated. That means based on the sample you selected, it is telling you that the material misstatement is very reduced, that there are no material misstatements, that they are unlikely. Meanwhile, if you check the other 70, it will give you a different result. So that the risk of incorrect acceptance, that's the risk of accepting the results you got from that population, accepting that material misstatement is unlikely, when in fact, if you have tested the whole remaining 70%, you find out that you would have had a different outcome. And now, risk of incorrect rejection is just the other way around. That's the risk when you say that there's a material misstatement based on the sample you selected, whereas in fact the whole population is not materially misstated. So it's just a simple phrase: sample risk, the risk that you go and accept what you are not supposed to accept, and the risk that you go and reject what you are not supposed to reject. So these are the two types of sampling risk: rejection and acceptance. Please put these things behind on your left hand so that you don't eat with it. At your level, CAT, all this population, what are we calling it? Sampling, they are easily tested for 3 marks, 4 marks, 5 marks. So, 1, know what the definition of sampling is. Know what the definition of sampling is. That's this is the definition of sampling. And although I mentioned to you that majorly sampling, audit sampling is application of less than 100% population on transactions. This is the definition. So please, it's in your notes. Try to get that definition. The types of sampling we have: statistical sampling and non-statistical. Under statistical, we have random, which is you select anyhow you want, giving everybody equal chance of being selected. That's, you do not use a criteria. Under systematic sampling, what we are saying is that select one figure randomly, then put a fixed interval in between them. 1 to 100, close your eyes and select 68. After 68, maybe you now put gap of 5. 68 plus 5, you'll be having 72. 72 plus 5, you'll be having 77. 77 plus 5, you'll be having 82, and things like that. So that is what we call systematic sampling. Non-statistical, haphazard, you select it anyhow, no pattern, no order. Block sampling, you arrange them, you group them together, maybe into months, maybe into serial numbers, and you select. Monetary, you use monetary amount. What are the sampling risks? Risk of incorrect acceptance and risk of incorrect rejection. For incorrect acceptance, that's accepting that there are no material misstatement in a population when in fact there are material misstatement. Why risk of incorrect rejection is saying that there is material misstatement based on the sample you have selected. Meanwhile, if you check the whole population, it's not materially misstated. So we said once the sample items have been selected to be tested, the auditor can begin audit tests using CAT or traditional manual testing. For some of us that are joining us for the first time, please read your notes. We have handled CAT, the different types of CAT, different types of software. They're all in your notes. But when you read them and you don't understand, reach out to your colleague or reach out to me. So when you evaluate and document your samples, what are you supposed to do? Now, the performance and evaluation of a sample must address some issues. What we are saying is that when you want to document samples, what should you have in mind? What should you have in mind? So these are the points here. One is that you must be able to plan the effect of not being able to apply a plan procedure to a sample item. That if you are going to document your samples, if there is any possibility or something happened that you were not able to apply planned procedure on the sampled item, you need to document it. A projection of the sample results to the population being tested. That means what we are saying now is that before you even start to test this population, you need to have a projection on what your results will likely be. So at the end of the day, you are going to be comparing the results with the planned amount. What do you get? What were you expecting and what did you get? So you must be able to document it, that we expected this, but based on this sample, this is what we have gotten. Appropriate consideration to the assessed level of sampling risk must be performed. Consideration to the assessed level of sampling risk. So that means you must assess to be sure what risk you are facing. Are you considering whether there is a sampling risk, and whatever you get, you need to document it. Then auditor is also, Grace, do you have a question? Yes, do you have a question?
Not yet, not yet.
Okay, thank you.
Yes.
Yeah. So the auditor is required to adequately consider the qualitative aspect of misstatements, such as the nature, cause of the misstatement, possible relationship of the misstatement to other phases of the audit. So you must document your work. What were you expecting? What are your plans? What did you get from your expectation and the actual result? You need to know. What was the assessed level of sampling risk? You need to document it and all that. So it must be documented in your working paper. What were the sampling objectives? What was the sampling process used? Did you use haphazard? Did you use random? Did you use block sampling? You have to put them down. Systematic sampling, you have to document it in your working paper. The source of the population, the sample method used, sampling parameter, items selected, detail of audit test performed, and any conclusion you reach. So please, these are some of the areas you need to know. What do you document in your working paper? What do you document in your working paper? Okay, so if you have any question, please drop it in the chat box. We are moving to a new topic. So when you talk of sampling, this is just a very, very small area, usually tested. I want us to finish this syllabus. So every day we meet, we are going to be solving questions together. We'll be solving computer-based questions together. So even if you are missing the class, whatever you do, do not miss the question practice. So if you have any question, please drop it in the chat box. We are moving to evaluation and review. I'm expecting your questions. Onyeka, any question? Zainab? Debbie?
No, sir, I don't have any question.
Okay. And Ayo? Okay. Okay. So, okay, Fola is just joining us. Yes, who is saying something? Okay, so now I need us to pay very, very big attention at this level. One, this is very important for certain reasons. Whenever you perform an audit, After performing your substantive procedures, your test of controls, then you need to do what we call review and finalization. This review and finalization is usually done before the audit engagement partner signs the audit report. You must carry out an overall review of all the work that has been done. So for a review and evaluation of all the work that must be done, it has to be carried out by the audit engagement partner. And the reason for doing this is to ensure that you are expressing the correct, a sound audit opinion, the correct audit opinion. So the rationale behind finalization and audit is to ensure that all appropriate audit opinions reflect the true and fair view on the financial statement the auditor is going to sign. True and fair view, meaning that all areas of the audit, the auditor needs to review the conclusions in those areas. What were the audit evidences gathered in those areas? What conclusions were reached? What were the opinions? Putting them together, you are coming up with an overall opinion. So this can only be done by the engagement partner. Why? Because he's highly skilled, he has knowledge, and is highly experienced. He has knowledge of the entity, much more skilled than the maybe junior workers. So please, so for this evaluation and review, there are certain activities that must be carried out. There are certain activities that must be carried out. Now, these activities include all these major activities: 1, 2, 3, 4, 5, 6. These are the major activities that you must perform, that the audit engagement partner must perform before he signs that document. Before he signs that document, he must carry out a subsequent event review. Now, for subsequent events, can somebody tell me the accounting standard that is responsible for subsequent events? What accounting standard treats subsequent events? Yes, I'm listening. I'm listening. Which international financial reporting standard takes care of subsequent events? Okay. Which
I think
standard?
it's ISC 10.
I what?
ISC 10.
ISA 10. ISA is International Standards on Auditing. Are we talking of
Auditing.
ISA or IAS?
Okay. IS 10 or IS 560. I'm not sure.
Okay. For accounting, I was actually asking for the accounting standard, and it is IAS 10. They call it events after reporting period, right? Subsequent events.
Yes.
Events after reporting period. So what we are saying now is that for the auditor must be sure that all subsequent events have been reviewed by the all subsequent events have been considered while carrying out this audit. Now, somebody should tell me, I think Onyeka, tell me, when you are talking of these subsequent events or this event after reporting dates, what is your understanding of this? You don't need to be wrong. You don't need to be right. I just want to know what your understanding is. When you understand it from the financial reporting point of view, then you can easily understand it from the audit point of view. Or if Onyeka is still thinking about it, somebody can help her, but I think she's ready to answer. What's your understanding?
Okay. I think events after reporting dates or subsequent events, there are events that occur after the year end, which can affect the decision of the auditor.
Okay.
or which are both favorable or unfavorable.
Okay. Okay, you have tried. I would come back to that. Somebody else should give it an attempt. Grace. And we have a lot of financial reporting experts in the house. Ayo, I know you're a financial reporting expert because I know you are doing financial reporting. Fola.
I don't think so. Let's part, guys.
Uh,
No.
okay. So, but I need you guys to attempt it.
Yeah, I think there are events that occurred between the reporting dates and I think between the that's reporting dates and when the report is maybe signed by the directors.
Okay. Yes. So that's so when they happen, because I want to actually make you guys think hard. So when you say there are events that happen between reporting date and when they sign, Onyeka said between the balance sheet date, which is the year end, and when the auditor signs the financial statement. We hear there are those events. What do they mean? Why are we bothered about them? Because your answers are actually incomplete. Yes, there are events from year end to when the auditor signs the report. Why are we bothered about these events?
Because the events happened before the reporting date, or there are events that have the ability to impact a situation that occurred before, or an existing situation before the reporting date.
Okay, I think you are getting closer. Onyeka, do you agree with Ayo?
Yes, sir.
Okay, so what we are saying, because I like us bringing these things down to the grassroots level. Now, what we are saying is that after the year end, certain events are going to happen, both favorable and unfavorable. There may be an indication of something that was existing before that year end. Something happened after December 31st. But when that thing happens after December 31st, let's say January 5th, it might just tell us that, oh, this thing that is happening January 5th is an indication of a condition that existed before December 31st. That is the issue about subsequent events. For instance, now, on your statement of financial position, you have a receivable. The receivable there is $2 million. And this $2 million, there's a particular customer that is owing you $500,000. Now, we know that receivable should be such that you can you expect an inflow into the entity by within 12 months. And as at year end, you believe that this same individual is going to pay you that $500,000. But by January 5, you were watching news, you were watching network news, and you saw this same person that is owing you $500,000 that he was paraded by EFCC to the court, and in that court they declared this debtor as bankrupt. Bankrupt means that he does not have the ability to pay all his loans again. He's a useless individual. So are you telling me that is that day, that's January 5, when you saw him on TV, was that the day he started becoming bankrupt? So what it means is that even as at the time he was owing you that 500,000 within the year, he was not able to pay. So such an event is a subsequent event that will require you to go and adjust that financial statement. And you remember what prudency concept told us, that all known loss must be what? Recognized immediately. Yes, and we should exercise caution, right, in recognizing profit. So what it means is that is not a favorable event. However, because you have seen it in the news that this person is bankrupt, you have no business, because it's a known loss. You have no business leaving that 500,000 in your statement of financial position. You have to write it off immediately. And I want to find out, if you are to write off such an amount, how will it be treated? Out of curiosity, let me just know if we understand what we're talking about. How will this $500,000 be treated? Because now you want to write it off. You want to recognize that loss immediately. What will you do from your financing point of view, financial reporting point of view?
I think you write it off as bad debt.
Yes, yes, if you say you write it up as a bad debt, I want to know what you will actually do to write it off. Because writing it off is like a statement of wish. So if you were to be preparing the financial statement and somebody tells you to write off that 500, what will you do? What journals will you pass? What journals will you pass? What will be debited? What will be credited? Let me put it, I don't want to mention debit and credit, because once I mention debit and credit, but if someone should ask you that, what would you,
Debit retain earnings.
you debit, retain,
earnings.
Why retain earnings?
Because it was in the last financial financial year, yeah.
Mm-hmm.
As in it happened in the previous year to this this year. You know, we're in a new year now, and so
yes, we're in a new year. Okay, let me help you. We're in a new year, but remember that what we're auditing is the past financial statement.
Yeah.
We're not auditing the new one, we're auditing that old one. But if we were to be auditing a old one, or we realize later that we need to correct an error, we usually correct it from retained earnings. But here now is that financial statement that we are adjusting. We have not concluded on it. So this financial statement we are talking about is yet to be finally signed, because there are going to be adjustments here and there. So what do you do?
I didn't get your question.
No. So what I'm saying is this: if it was an error in line with either a fraud or an error in line with IAS 8, we'll do that through retained earnings. But now we are saying that this is the current year. You know, we are in January, but remember that we are working on the financial statement of last year. So you may not need to. So once you are able to, okay, what will you credit? Somebody should help. What will you credit? Which account will you credit? You credit one account, you debit one account.
Let's say you debit you debit balance brought forward.
Okay. And you credit what?
And you credit oh god, no. I'm not sure about that one though.
Okay. Ayo, let's assume that you are correct on
Honestly, sorry, sir, I missed most of the question because the internet was funky.
Okay. So first things first. So let me just refresh you guys' memory. You need to understand that receivable is a debit balance, right, in the financial statement. And when you want to increase the debit balance, you debit it. When you want to reduce the debit balance, you credit it. So we are saying we want to remove that 500,000 receivable. So what it means is that we have to credit receivable. When we credit receivable, we have removed from it. Now the issue is that where is the second leg? Where is the second leg going? It would have gone to retained earnings if we were trying to correct prior year errors. Do you understand? Prior year errors. But now, since we are working on that same financial statement, it should go to the income statement. We are writing it off. We are writing it off into the income statement. Do you guys understand? Yes. Okay. So let's go ahead. You have to also review going concern. Can somebody define the meaning of your understanding of going concern concept and why do entities use going concern method in preparing their financial statement? You have to take these things one by one. What do you understand by the going concern assumption, and why are entities expected to use this assumption when preparing their financial statement?
Main concern, that's continuity of the business of the.
Come again, Grace.
That's continuity of business transactions.
Okay. So when you want to define going concern, you don't just say continuity of business transaction. You say it is an assumption that a business will continue to exist into the foreseeable future. Then you must have properly stated it, yes. So not continuity of transaction, it's continuity of the business, that business will continue into the future. So what we are saying is that the auditor must review that financial statement to be sure that the entity will continue as a going concern. Then you also need to collect management representation in certain areas. I will tell you the meaning of that. Review other reports that are published in the same document with the audited financial statement. So I don't know if there's anybody here that has seen a financial statement before, an audited financial statement. Have you seen one?
Yes, I've seen.
Okay, so if you have seen one, you would have noticed that in some financial statements or financial reports, you will notice that they always have multiple figures, corresponding figures. You have for 2019 and 2018 staying together. At
Yes.
times, you even have different reports, chairman's reports, management profile, the names of those people. Sometimes they even include their forecast, 4-year forecast, 5 years forecast. They include projections, where they want to be in 5 years' time, where they want to be in 10 years' time. Their social corporate responsibility reports, and so many other reports that may be required as part of the jurisdiction in which they operate. So for the auditor too, it needs to be sure that those reports that are published alongside that financial statement are saying the same thing. Are they consistent? So that the financial statement is not saying something else and those reports are saying something else. For example, the other reports published by the chairman is saying that, oh, by next year, we are going to be able, in the next 2 years, we see ourselves making profits of $2 billion. We also see a situation where we produce a generator that will be using water. Now, the financial statement may be showing a consistent loss. Excuse me. Loss from last year, loss from 2 years ago, loss from 3 years ago. And all of a sudden, the chairman is telling you that next year he's going to make a profit of 2 billion. Now, this same chairman has already told you again that they're going to make a generator and a car that will be able to fly. If a generator will use water or a car will fly, I believe that in that financial statement, you must have been seeing some kind of research and development. I don't know if you get me. Some kind of research and development that is already showing that they are working towards certain things. And those for research and development, you know the criteria on which they should be capitalized or expensed, as the case may be. So this is the risk. And that is why auditors will usually want to carry out a review of those other reports so that it does not water down the effect of the financial reports which they assign. Then you have to check opening balance and comparatives. Where the balances from last year, were they properly carried over to this year? Hope there were no errors when they were carrying balance brought forward, as Grace said. Hope there was no problem when they moved it to the opening balances. Comparatives, when you have 2018, 2019, are you sure they properly moved the 2018 figure into that financial statement? Are they correct? You have to check those comparatives. You have to also do an overall conclusion. Okay, So that is just to give you a rundown. So now let's move to subsequent events. We said subsequent events are those events, favorable or unfavorable, that occur between the reporting dates, that's financial year end, and the audit report date, that's the date which the report is signed by the auditor. So the auditor is supposed to watch out for any event that takes place after that year end to when he signs his report, so that some of these activities may actually show him indications that that financial statement needs to be edited or corrected. So they include facts, knowledge of the report, and anything that may have happened, any event generally. For instance, if there's a fire event in the warehouse on January 5, this fire event has burnt down all the inventory. But remember that the financial statement is carrying inventory figure of $1 million. But in reality, if you get to the inventory store today, there is nothing in that inventory store. Why? Because fire has burnt it. So this is a subsequent event that may require adjustment or not. So in line with IAS 10, which Onyeka said, certain events will be adjusted or not. So in the case of this fire that I've mentioned, do you think when fire has burnt down the whole inventory and the inventory figure in the financial statement is stated as 1 million, do you think it should be adjusted or not? Should it be adjusted? It should be adjusted. Okay. Why do you think it should be adjusted?
Because leaving it there will have overstated the profit for that end of the year report.
Okay,
So,
leaving it there means that inventory might be overstated.
Yeah.
Okay, very good attempt. Fola, what do you think? Grace, what do you think? The four of us that are remaining in this class, I think let's push ourselves a bit. So Ayo has said that he doesn't think it should be there, that if you leave it there, this might amount to overstating inventory. So Grace, what is your take? Fola, what is your take?
I think it should not be left there.
Okay. Grace says she thinks it should not be left there. Okay. Why?
Because I think it's going to affect the statement in the. It's going to affect what is in the financial statement.
You said it should be left there.
No, it shouldn't.
It should not be left. Okay.
Yes.
So that means you're in the same position with Ayo.
Yeah.
Ola, over to you. Okay. I think Fola has gone to eat pounded jam, but he's pretending that he's with us.
I'm back, sir.
Okay, welcome. So what do you
Thank
think?
you, sir.
Did you get the question?
No, I did not.
Okay. Fire has burnt out the inventory of 1 million. This fire burnt it January 5th. The fire burnt it on January 5th. Now we are talking of subsequent events. We are saying that certain events need to be adjusted, some do not need to be adjusted. In the case of the person that was bankrupt, I think we all agree that we have to go adjust it, because even that guy that they showed the network news that is bankrupt by 5th must have been bankrupt since. Now that there's a fire, what do you think we should do to that financial statement? Should we adjust it or not? When we say adjust, that means should we remove that 1 million from the financial statement or should we leave it there? For Ayo and Grace, they have made their position. So I want to hear your own position.
You said fire burnt the goods.
Yes, the goods in the store on 5th.
I think we're supposed to adjust it, sir.
Adjust it. That's when you say adjust it, that we should remove it from the financial statement.
Yes, sir.
Okay. So that means 3 of you are on the same position. Okay, that's great. So what we are saying now is this. I'll answer your question because it's actually your note, but let's continue. So we said IS adjusting events are according to the standard now. We have left, we said according to the IS 10 accounting standard, say that directors shall amend the amounts recognized in the financial statement to reflect adjusting events as at the reporting date. Now, I think our problem now is that how do we determine which one is adjusting event and which one is not adjusting event? But from the definition I gave you earlier, I said subsequent events are those events favorable or unfavorable that occur between these dates and these dates, and that some of them need to be adjusted, some do not need to be adjusted. So for the fire, remember that as at 31st December, that item was inside the warehouse.
Yeah.
So if it was inside the warehouse and the financial statement refers to that period of January 1 to December 31st, 2019, why should we adjust it? Because the inventory was actually existing as at that day. And if the inventory was existing as at that day, it should not be written out. However, there can be a disclosure in the financial statement telling the users of the financial statement that the inventory of 1 million got burnt after year end and it is no more there. But it was there as at 31st December. That is why we should not adjust it. So, Fola, you are wrong to say we should adjust it. Grace, you are wrong to say we should adjust it. Ayo, you are wrong to say we should adjust it. So, but it's actually a thin line between being able to identify whether an event should be adjusted or not. So I gave you some examples. Now you can have a court settlement of court case after year end, which confirms that the entity had an obligation as at the reporting date. So we are saying you need to adjust this. Adjust in the sense that when they settled this case, the case was already existing. And you know that when we are talking of provisions, we are saying that if it is highly probable that there will be an outflow or inflow of economic benefit due to this court case, then you may need to adjust it. If that, okay, yes, Ayo, you have a question.
Okay, sir. Like you know, the inventory was counted on 31st of December.
December, yes.
So, and it has been noted that they are 31st, they are like, let's say,
$1 million.
Yeah, like 10 million is the value of the inventory at 31st of December.
Yes.
Okay, and then on 5th of January, the new financial year,
yes,
then it was discovered that
fire.
Okay, yeah, I think I get it now.
Okay.
As maybe the fire should have happened right in before 31st.
If the fire happened 31st, then you adjust.
Then you adjust.
Yeah, so the fire did not happen 31st. At the 31st December, that inventory was intact. It was counted, it was intact. So a subsequent event that happened was that the fire has consumed that inventory. Now, because it was there as at 31st, we don't have to remove it, but we can include a disclosure that states that fire has gutted the inventory. Unlike the other one where we were talking of the bankrupt issue, yes, as at that day that you saw that man being convicted of bankruptcy, that was not the day he became bankrupt. That was the day they gave the judgment. And again, when we now apply prudency concept to the case of the bankrupt debtor, then it shows us that, yes, this man, even though we did not know, obviously he was already not having ability to pay. And we said all known loss must be recognized immediately. And as soon as we have not, so there's no need leaving it in a financial statement that has not been signed, you have to go and take it off immediately. Just write it off. Now, asking what do you debit, what do you credit? So, so look at this second example. If you receive information indicating that an asset was impaired as at the reporting date, or that the amount of a specialized recognized impairment loss as at that of that same asset needs to be adjusted, you have to go and adjust it immediately. Because now, by January, I get information that shows that, okay, just like this COVID-19 now, this COVID-19 that is happening now, as at most hotels, you know, they carry so many, they try to pop up their assets like that they are building. The reason they are popping it up is to show you that, oh, they are going to be having customers, people are coming. And do you know that any property you want to buy now, the price has gone down? Do you all remember that in Metama 1 year, you see houses of 700 million, 800 million, 900 million? Those properties remain there for years and nobody is buying it. Nobody is renting it. Are you telling me that that property now will remain at that amount when obviously there's nobody buying those property? So
No.
yes, they will remain. It shows that it has been impaired. And in such a case, you need to go and adjust such a property if you are carrying such a property on your statement of financial position. Because the truth is that as at that year end, it shows that even that asset has been impaired. Customers are no more coming there. If it's an hotel that is having goodwill, a goodwill now that you have in your system as maybe $2 million because people come, people like that hotel. But with this COVID-19, people are not using hotels anymore. In fact, government has even said that hotel is a no-go area. All hotels should be closed. So that's goodwill that you have recognized as maybe part of your ambience or whatever it is that made you to take that goodwill figure as it is. It shows that it has been impaired and immediately you have to adjust it. That is also still in line with the issue of prudency. Now, you can see this C, the example I'm giving you in C is the bankruptcy of a customer, which occurs after reporting date. Excuse me, please. Okay, so so the example in C is what we said about the customer, which we said you must write off the entire debt immediately. Look at it here. You have to write off that debt immediately because he has been declared bankrupt. Yes, you have to write it off because it's a loss which you now understand. Now, these last two figures, if you sell inventory immediately after year end, and it gives you, Onyeka, are you with me?
Yes, sir.
Yes. As at December 31st, your inventory is showing $1,000. You have $1,000 worth of inventory. And this $1,000 worth of inventory, by January 15th, when they sold this same inventory, you realize that this inventory is being sold for 800. Now, will you still leave that 1,000 there, or you recognize it at 1,000, or you change it to 800? Which one will you do? Will you change it to 800 because you realize that the net realizable value of that inventory as at January 15 is 800, and the net book value as at year end is 1,000? Will you leave it there or will you adjust it?
I think we should leave it there.
Okay. Onyeka, what do you think?
I'll adjust it
Why?
because the inventory is meant to be measured at lower of cost or net realizable value.
Thank you for that. So, Grace, you can see that inventory following IAS2 already says that measure it at cost and net realizable value. Now, as at January, net realizable value is carrying 1,000. As at that January 15, net realizable value is carrying 800. The net book value is carrying 1,000. So for such an item, now remember that any inventory you are going to sell after year end is still going to be 800. You sell it. So why are you leaving it at 1,000 when you already know that as at this date that you are talking about, this subsequent date after year end, that inventory costs 800. So you can't leave it at 1,000 when you know you are going to sell it at 800. That way you are trying to actually manipulate the financial statement because you'll be reporting a loss. But now, to be realistic, inventory should be measured at lower of cost and net realizable value. So a subsequent event that has happened is that inventory after reporting date shows that the net realizable value is 800 and it should be carried at 800. So that is an adjusting event. So I'm very happy that you are telling me otherwise, Grace, because what it means now is that you need to read your IAS 10 properly and you need to read this note properly. Look at all these examples that I've given in the notes and you use it to. So with time, I know you are going to get it. So it's not like because it was there as a year end, you have to leave it there. No, IAS2 is clear. Lower of cost, net realizable value. And you are still working on this financial statement and a subsequent event has indicated that the value of that inventory has reduced and that is the value you have to carry it in the financial statement. Now, if you discover a fraud after year end, which shows that the financial statement was incorrect as a reporting date, you can imagine that now, just like the same one that we talked about, IAS2, this is IAS 8. Am I correct? IAS 8, yes. And this, that's
Okay, don't worry.
that's the one that talks about. So this one is IAS.
Yes.
IS2.
IAS2. Thank you. IAS2. So now, in line with IAS 8, it says that when you discover any fraud or error, you have to do it retrospectively. You have to go back to the beginning and go and correct it. So, Ayo, this IAS 8 now, if we were discovering an error or fraud and want to go back to like 2-3 years ago, we can now go to retained earnings. Do you get it? Because all the profits and the surpluses that were recognized in that year was taken to retained earnings. And you know, retained earning is the balance as at a particular date. So we'll go to retained earnings and go and correct it. But in the case of receivable, you will not take it to retained earnings. You can only go to retained earnings if that item has already been recognized in prior year and it has formed part of your profits that entered retained earnings. So you are going to retain earnings to remove it. But for the example of the bankrupt customer, it has not gotten to retain earnings. So you just write it off immediately. But if, let's say, that debt was recognized in retained earnings like 2 years ago, then you can go there. Or, for example, now, yes, thank you. If you realize that this man that you said is bankrupt, all of a sudden, after 2 years, God pick his call and is now as in just blew overnight. And he has decided now that he wants to come back and pay that his debt of 500, then you go to retain earnings. Because you recognize it in the income statement of that year, and that year has gone, you can go to retain earnings. So let me not confuse you, but I hope you understand what I mean.
Yes.
Okay. So for this, we said you have to go back and back and back to correct any errors. You have to correct this one. This is also a adjustable event. So let's quickly go through those that are non-adjustable events. For the non-adjustable events, we have those are subsequent events that do not require adjustment to the amount recognized in the financial statement. Even when they are material, they do not require adjustment. And examples, a decline in market value of investments, like shares, you know, if shares, for those of you that follow shares and follow stock market, do you know that if Donald Trump should today say he's going to kill the president of Saudi Arabia, you will see that all of a sudden, most investments will start nosediving. People will not buy shares. Investment in shares will be reduced. Now, for such a situation, you can't go and start adjusting your financial statement for an investment value that has gone down, like a shares, because it does not relate to something that was existing as at the end of that accounting period. So you do not need to adjust. However, you can give disclosures. You can give disclosures on that investment, but you don't need to adjust it because it's an investment. And don't forget that that investment that went down, that declined, it can bounce back again. So how many times will you be going to your financial statement, go and increase it, reduce, increase, reduce? No. So for market value of investment, which is shares, you do not need to adjust. Dividend declared after reporting date, you do not need to adjust. Now, fire incident. Occurrence of a fire incident after year end which destroyed goods kept in an entity's warehouse. It's important to know that whether the stock of inventory was insured or not, it remains a non-adjusting event, which implies that inventory balance as at prior year end need not be written down. However, where material inventories were insured, it becomes necessary for the directors to disclose the fire incident in the notes due to possible implication on going concern. So if your inventory is so material, you need to let people know that this inventory, what so much has been destroyed. Now, to conclude on this subsequent event review, I need to give you this diagrammatic illustration of what the auditor's responsibility is from year end and audit report dates and AGM date. This year end, we're assuming that this is 31st December. We're assuming that this is 31st December. Audit report dates could be any period. Let's say the audit reports will now be signed, say April 20th. Let's assume. Now, what is the role of the auditor between this 31st December and audit report date? What is the role of the auditor between this date that he has signed the report and AGM date? So he has different responsibilities. For this date, for this period, between this year end and audit report date, the auditor has a very active role. When we say the auditor has an active role, what we mean is that the auditor must still perform procedures between this date and this date on anything that happens, any subsequent events. He has to perform procedures so that he can satisfy himself. Whether he's adjusting or non-adjusting, he has that responsibility until he signs the report. So that is why, hold on please. Okay, so that is why we are saying that the auditor has an active role between year end and the day he signs the report. That is why we are saying that the auditor must review all subsequent events. That he must get evidence that the directors have reviewed all subsequent events and they've adjusted those that need to be adjusted, and those that do not need to be adjusted have been left the way it is. However, if it is material and it does not need to be adjusted, you can disclose in the financial statement. But for anything that happens between this period, between the day that he signs that report and the date of the annual general meeting, he has a passive role. We said active role means that he is still supposed to do what? Perform procedures. After signing reports, what procedures do you want to perform again? You don't have that duty or right to perform any procedures again. So this is just a diagrammatic illustration. Year end to reporting date, he has an active role. That means he can perform procedures. From this date to this date, that's audit report date to AGM date, he has a passive role. So what are the audit procedures to identify subsequent events? One, the auditor should obtain the established client's procedures for issue. The auditor should obtain the established client's management procedure for identifying subsequent events. He should ask them, what are your procedures for identifying subsequent events? What procedures? So that you know whether these procedures are working effectively or not. Because it's not his responsibility to identify. Actually, those preparing the financial statement are responsible for identifying these subsequent events. Now, another procedure is that he has to get latest management accounts or even get minutes of board meeting. Because if there are any subsequent events, do you know that the management are actually going to discuss it at the meeting? Those charged with governance are going to discuss these issues. So if he's able to get the minutes of board meeting, what it means is that he can look at all those things they discuss one after the other. Do they lead to that financial statement being adjusted or not adjusted? Do they need to be disclosed or not? You know, the principle of financial reporting is basically about fair presentation. You have to present that financial statement in such a way that it shows a true and fair view of what is happening in the entity. So he can also discuss, inquire from them, you know, those areas they use judgment. He can ask their company solicitors whether there are any outstanding litigation. Is there a litigation? Are they in court? Has anybody taken them to court? And if, for instance, there are issues where they've been taken to court, that means the auditor needs to get an expert or need to even ask this solicitor, what is the possibility of this case going against my client? And if it goes against my client, what is the impact on the financial statement? You know, and again, see what I wrote here. I said the auditor needs to obtain written response. Why does the auditor needs to obtain written response? Can someone tell me why the auditor needs to obtain written response? Yes, I need somebody to, I need someone to tell me that.
You mean written response from the solicitor?
From the solicitor, yes.
Okay. I think for the purpose of documentation.
Okay.
And then because, you know, this kind of something, now, if it's very probable that there's going to be outflow from the company, you understand, the auditor will have to, you know, make them to make a provision.
A provision for it, okay.
Yes, for it. And
yes.
Yeah. And so I think to justify that, there has to be a kind of written response
from the solicitor.
No,
and again, because even if anything is done based on a verbal response, it can be denied. The solicitor can deny you in future and say, I did not tell you that. So that is one of the reasons why we said we have to receive written response so that you are not denied in future. Okay, we can also inquire from clients management or other sources. So when you are looking at subsequent events, that means you'll be reading newspapers, radio, magazines. That's your source of subsequent events can be from anywhere. Network news, radio, anything can happen that makes you identify subsequent events. Now, for instance, do you know that the prices of oil has gone down? Now, if there's a financial statement that shows, hold on, please. if there's a financial statement that shows that a particular entity like Shell, now they are carrying oil, their barrels of oil at maybe $50 per barrel. And now today is April or May 2nd, they have not signed that financial statement. And not signing that financial statement, we now realize that price of oil has dropped to $10. What do you think we should do? Please give me a second.
Onika Alpha. Onika.
I'm fine.
Yes. Who is laughing? What should be done? The barrel of oil was for the barrel of oil was showing $50 as what they've carried in their financial statement. Now with COVID-19, the barrel of oil has changed to $2 per barrel. Will the auditor ask them to change it or not? Is it an adjusting event or not? Is it an adjusting event or not?
You know, I think some other things may need to be considered.
Okay, like,
you know, depending on maybe the contract signed and where the goods are, because you said Shell, and I don't know, maybe the oil was in transit,
okay,
and they had a kind of agreement on ground.
Whoa.
I don't know, so you need to expand on the question.
okay. But I didn't think of expanding. You know, I was just looking at it from their inventory. I'm not looking at it from something that is in transit. That's why I said in their inventory, that's in their store there, under the ground, that crude oil, or maybe in their tank farm now. Let's assume they have crude oil in their tank farm. And in this tank farm now, they have already carried it in their financial statement that each barrel of oil, they put a benchmark of 50. And because of this subsequent event of COVID-19, oil went as low as -38. It now adjusted, came back to zero, then came back to maybe $2. Let's assume it's $2. For me, I think, and oh,
Since
yes,
since it's inventory, you know, then the rule, as mentioned earlier, of IAS 2, we
suffice.
apply.
Okay,
Yes.
yes, thank you for that. And I want to also tell you that even the Shell I'm using as an example, they've already declared a loss already for the quarter. They declared a loss because already they have to recognize all those their inventory at a particular amount. And compared to last year, when they had billions of dollars worth of profit, this same period last year, this year now, they're already declaring a loss. Okay, so you need to be careful, but as we solve questions, we're going to be able to identify this. But when the time for question comes, please, I beg us, let us try as much as possible to be in that class, because there's no how we're going to solve like 5 diets worth of questions that you will not pass this exam. Or you are going to finish your revision kit that you will not pass this exam. Okay, so these are the procedures that should be performed. Also, C, obtain written representation from client's management that all subsequent events have been what? Identified and properly treated and disclosed as required by the standard. So you must get that written representation because you don't know all the subsequent events. The one you know is the one you know, but there are some that you may never ever know. So you need to put them on their toes so that they don't run you into trouble. You too, you collect written representation. Management, kindly help me write written representation that you have identified all subsequent events and that all these subsequent events you have adjusted, you have treated them properly according to the standard. So now, I already mentioned, I said for events that are discovered after the audit report, But before the financial statement are issued by management, certain things can happen. I think I want us to stop here. Somebody should please take notes. We're going to start from here tomorrow, so that those that have another class can prepare for that class while I also prepare for getting into my class. Then please also prepare during the week, even though work is starting for some of us. I don't know if it's everybody that will be returning to work. Please, let's try and finish on time so that we can now start solving questions. And for those that are solving questions already, if you have any challenges, please reach out to me. Only very few of you are reaching out to me. Does that mean the rest are okay? And if the rest are okay, I'll be glad to hear that. So if you permit me, I'll end this class now.
Thank you, sir.
Okay, thank you.
Bye-bye, sir.
Bye-bye.
Thank you, sir. Bye-bye.
Okay, bye.
Bye.